Good morning, traders. Welcome to Weapons Trading. My name's Alan. I've been trading for about 20 years. I've worked for many of the larger tier one investment banks, mainly around London, and I've been looking closer and closer at crypto trading. I also ran a private investment company over in Europe, and we looked at cross-market macroeconomic trading strategies. However, I kind of gravitated towards cryptocurrency, and so I'm trying to combine all that knowledge, all that experience into one place and give it to you for free. And the reason being is because I noticed that there are many scams, a lot of gurus around in the markets who don't really know what they're doing. And this is very dangerous because ultimately your capital will be at risk. So I'm offering these videos free of charge for you to take advantage of. Subscribe and like if you like. If not, no worries, doesn't matter. But I will be giving daily updates and trading signals of where I believe that would be a good opportunity, good risk rewards. I'll also be following up with other videos that goes over the fundamentals and technicals that impact crypto trading. So as an example, we've got a connection now between Bitcoin and the S&P 500. And the reason being is because as soon as these larger organizations started taking on Bitcoin, they are now exposed to Bitcoin, and when interest rates go up or down, or if there's some kind of market impact, well, then what they'll do is they'll either add or decrease risk on their portfolios. This obviously has an impact on the buying and selling of Bitcoin itself, because now Bitcoin is included on their portfolios. And obviously, if there's a lot of buying pressure in Bitcoin, this will have a subsequent impact on altcoins as the money flows downstream. But we'll get into that in a different video. At the moment, what I'm doing is to start off. Again, this is for people who are just starting in trading, or if you've been trading for a while and you haven't been that profitable, or you're struggling to get consistently profitable. Well, I'm going to show you just my strategy, what I use. It involves a certain risk management strategy. It involves a certain kind of technical analysis, and obviously the psychology that goes with it, right? And normally, if you feel that you're in a trade and you can't get out of that trade because you don't want to take that loss, the odds are you're too highly leveraged. A lot of other people say that you should not use too much leverage. I say, you know what? It's like climbing a mountain. The more experienced you are, the less safety equipment you probably need, but you can still fall, right? You just got to make sure that you don't hurt yourself too badly if you do. So in the beginning, what we're going to do is we're going to start off with, say, $10 in our account. Yes, only $10. That's all we're looking for at the moment, because we are using leverage, so we can take larger positions with less amounts. Now, the reason I'm doing this is because I know that $10 is a reasonably small amount, right? It's a very obtainable amount. Many other traders, they say, well, you need at least $30,000 in your account. But I thought, well, given the laws of exponential interest and compounding gains and so forth, let's start on something really small, so that if we do lose £10, well, it's only 10, but lose $10, then it's only $10, right? So this is how we're going to be starting off. Now, I don't want to go too much into it. But for now, what I'll do is I'm going to give an overview of my approach to trading Bitcoin. At the moment, I'm teeing up for a short position, and I will just go through this now. Let me just quickly scroll out onto Bitcoin. We're now looking at an hourly chart. When you look at the screen at the moment, you can see that on the 9th of November, 2022, that's where we kind of hit the bottom of the markets, right? So if we extrapolate from there, you're looking at about 220 days, 219 days later, you had another kind of flush in the market there, right? And then if from after that, another 222 days-ish, we have another flash in the market. And again, we have another one and another one. The latest, so every 220 days-ish, we tend to have a bit of a pullback. Now, if you're into market cycles in terms of timings, I would highly recommend you going to find Bob Lucas. He's a very experienced trader. I think that if you're following Bob Lucas, well, then you're certainly in good hands. So he looks down to 4-year cycles, 32-week cycles, and I think also the 60-day cycle on Bitcoin. So if you're into that, looking at timing bands and when's the best time to buy, I would highly recommend you look into them. In terms of timing, we can see that we are due for a flash in the market. Let's extrapolate this, say 220 days. That will take us to the 13th of November. So let's just go and put a little triangle here. Okay. So now we can say that if this pattern carries on, and we can see how much we went down here. Look at this. We went down on Bitcoin. We went down 30%. That's a pretty punchy drawdown, even for Bitcoin. And the reason being is because Bitcoin has a very large market cap. It's a couple of trillion, which means that you need loads of outflows and inflows for it to move Bitcoin these days, just because its market cap is so high. So what we can expect is that there will be some kind of a pullback going into this timing band. Now, if we look at horizontal levels, you can see here, these are your support and resistance levels. The way I do it is I have a look at the chart and I will look at where there's been an uptick, down, or spike, where the markets are bounced off, and then we can determine where the support and resistance levels are. So if you see here, we came down, we tested there, we went back down again, went up, tested up again. So we kind of got a very good resistance around about, say, 25,000. And then you can see we broke above that. That means that resistance turned support, bounced it off twice, and then off we went. Over here, we can see we bounced off these lows over there. You go 1, 2, 3, 4, 5, 6. So, they really reinforced the support over here or this resistance level over at 31. Bounced through there, and off we went again. And then we got another one there. So you got all these different horizontal levels going all the way up. Not to mention, and tends to be my favorite, are these diagonal levels. Now, diagonal levels are not for everyone. They are meant to be broken, but they do give you a very good idea of the trend and when our trends change. And this is very important because even though we're going to be bouncing throughout these little levels on the way up, so we hit the resistance, bounce back, bounce off support, go through resistance turns support, then bounce off again, and then we keep on going up. We can't go up forever. And normally when we have the break of the diagonal, it indicates that we're now rolling over and we should go all the way down the mountain again. Not all the way down, but we'll start descending. And you'll hit these support levels on the way down that were made on the way up. So it's far easier to trade. You see, what we're doing now, because we're using leverage trades, we're trying to maximize the amount of reward we get compared to the risk that we're taking in order to take that trade. Now, we're going to be getting to my latest trade at the moment, but this is just kind of looking at the structure of the market. Now, let's overlay this with not overlay, but have a look at the Bitcoin dominance. You can see over here, Bitcoin has been doing very well since it tanked around about 2021, obviously, and then it's been building its way up. Now it's breaking down, which means that altcoins are going up or Bitcoin's going down. Given that Bitcoin's still going up, it means altcoins are really going up, right? So that tells us that money is now flowing from Bitcoin into Ethereum. Ethereum, larger caps, medium cap, nano caps, rinse and repeat, and we start the cycle again. But people are going to be taking profit now in Bitcoin, and as they sell Bitcoin and go into altcoins, you will have almost a sideways movement in Bitcoin while money starts going into the altcoins, right? So if we look here, we've kind of popped up a little bit. We've got, this is on the daily chart for Bitcoin. You can see that we've got these little spikes down here. So we've got this kind of resistance level over here. Okay. But moreover, if we go down to the 30, I don't do this very often, but you know, when we are trading, we can do this. It's sometimes easier to have a look at the different technical analysis, right? So if we go and we take that, we take that, we clone that, we can kind of create a channel here, right? But now what we've seen is this is kind of going up there like that to form what it looks like is a bear flag, right? So what we've got a number of things happening here. Okay, we've got these all-time highs coming off the all-time highs. We're going up into a bear flag. And now we can expect another thing down, another leg down. Now, if you know Elliott wave theory, we're going to overlay Elliott wave theory as well. In fact, we're going to use a few things. We're using Fibonacci's mainly, and then a little bit of Elliott wave, normally on a pullback, but that's more for verification, right? So what we're doing is we're looking at the extension here. So if we go from here to here, and bring up to about there, we can see that the 121 ends round about 100. So if you look at the 0.78 retracement, you're looking at about this level here, which is about 102, and a 121 is very strong. That's going to put us round about 98. So you're looking at about 100K on Bitcoin. So what I'm saying is that we could have an extension down to here. So let's just put Fibonacci to one side. All right, let's go put that to there. Okay. When we come down like that, test either that level or that level, we will then be within our timing band for the 220 days section. So we are expecting a bit of a flush down here, like we had over there. You see this long kind of decline here. That happened. Well, we're expecting that to happen, to come down here, right? And that will tie up very nicely with a ABC correction. Okay, let me just go find an ABC. So it'll go boom, 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 boom. And an ABC correction, if you don't know, in Elliott wave theory, you have an impulse wave that goes one, boom, 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 boom. And what you'll have is that will go up. You normally have a pullback that is about half of that leg up. And then you'll have an extension that goes up, which is normally 1.618, the distance of that. Then it pulls back the same distance as between 1 to 2. So it's asymmetric or symmetrical, and then you got your last leg up, which will be the same distance as that one. Now, these don't always line up that accurately, but they can. However, what I find is that the ABC correction tends to be far more reliable. So that'll go down like that, boom, boom, and then it'll do an ABC where the A to B will be the same distance as B to C. And normally you have a 50% retracement going up. So it goes down, retraces 50% of that leg, and then goes down again the same distance or similar distance from A to B, right? And then what it does is, again, rinse and repeat. So that will then go there. And then that is how the markets kind of make their way up. Now, that leg there can be in many different ways. There could even be a consolidation going over here. So leg 4 to 5 may be a consolidation, but leg ABC tends to be pretty specific. So let's get rid of these here. Okay, so we can expect some kind of an ABC correction that will take us back to this lower rising trend line over here. Let's go back to over here. There's your ascending trend line that goes up like that, your support. And so it should bounce us very nicely over here for a setup to go long. Okay, so we've got a number of things here. Okay, we got A. Let me quickly go over here. If we look at the retracement from here to there, you can see that we've come down. We've gone retraced exactly onto the 50% as we said on the ABC correction. And now we should at the very least have resistance, which we found. Over there, you can see this is a very strong trend change here on the candles. So on the daily, you can have a nice long wick. So false break, come back down, and now we can go. That's kind of flushed out all the shorts. And now we're good to go short. Bounce just on the 50%. So we've got an A, B, C that should land us at the bottom of this ascending resistance. If that breaks, well, then we need to start questioning the bull run somewhat. Or if that breaks, it just means that we're going to consolidate sideways on Bitcoin while money flows into Ethereum. So as you can see, we are going up a bit in Ethereum and we're going down in Bitcoin. So this could give rise to the fact that over here, if we break through this level on Bitcoin dominance, that kind of makes sense, right? Because you've got this trend line going over here. We hit the trend line there, and we went all the way up to here. It's breaking through that. If that, we were expecting Bitcoin dominance to shoot back down to say 54%. We're at 57% now. If that happens, it means that Bitcoin is either tanking or it means that Ethereum is going up. Right now, it's making that combination. This also gives rise to a few other setups. So over here, we're looking at graph. I've got a few altcoins that I look into, and one is a graph as well. Also like Radium, Drift, Sui, Near. There's a few things over here that I kind of like. You can see we've kind of touched this support over here. Well, this is resistance. It's over there, there. So this is your horizontal. It's going to hit its head. When we descend on Bitcoin, it should pull it back to about this level. Maybe bring this up like this. It should hit us around about these levels here, right? So what we're looking at is we're not going to short altcoins. We don't want to do that. Okay, if you short altcoins, yeah, they can pull back really hard, but they're also prone to massive spikes to the upside. If you're leveraged, it's game over, right? So you don't want to risk being leveraged on a short altcoin position, because all it takes is a bit of FOMO in the market. All it takes is for someone to spit some fake news or whatever it is, and what you do is you get a little bit of a pump and dump, and that's it. You are losing money at a very high rate. So let's have a look at what our risk reward is going to be on this one. Let's go and get a, sorry, there we go. We're getting a short position. So our entry, I took it last night, was a break of that trend line. So we're going to put our stop just above that wick. I went in at that trend line about there, and we're aiming for potentially the first line there. Okay, I would say around about 105-ish. It more than likely going to pop down to get the bottom range around about 100, but we're really looking at a risk reward of 1 to 12. I mean, that's an outstanding reward, right? So this is just the setup for a short position on Bitcoin. If we go down to the 30, it should be starting to make its way down. I'm going to try to get this out. You can see there, a little wick above there to break the resistance, get everyone excited, and then reverse. But I'd expect this to keep on going down. We should break the bottom of this ascending support, given that this looks more and more like a bear flag to me. So I would say, yeah, it's a good place to take a position. Even if you took it right now, you're still looking at a significant risk reward. Now, on it, I'll do a separate video that deals with. I mean, even if you take down to that level, you're still looking at about, say, 4.3. I'll do a different video that looks at position sizing, just to ensure that you don't overexpose yourself onto the market. The way I do it is that, yes, I am putting on a significant amount of leverage on my first position. But then what I'll do is I'll have certain levels. So as soon as I triple my money, which happens quite quickly when you're trading on leverage, as soon as you triple your gains, then and only then do you increase your nominal trade size, right? And the reason being that if I'm trading, say, 1 Bitcoin, I mean, that's a large position, but let's just say 1 Bitcoin and you double your money and then you lift it up to 2 Bitcoin, all you have to do is to have a bad trade that's half of your gains, and you wipe all your profits out because you're now exposed twice as highly as you were to when you were making money. So if you keep on increasing your position size as you're making money as a percentage of your overall capital, what's going to happen is when you do lose money, by common sense, you'll be losing money at the very highest amount in your account. All right, you'll be at the most exposed. And the best way to do this, in my opinion, is to ensure that you don't increase your position size in between different levels. So, as I've mentioned before, we're starting off with £10, a mere £10. In all honesty, I mean, yes, I am 50 times leveraged on Bitcoin, and just to take a decent size, but we are leveraging it so much because we're only going in with $10, right? So because we're going with just $10, then we can put a little bit of risk. As soon as that gets to, say, $30, what I'm going to do, I'm going to up my position size again, but I'm not going to increase my position size until I get to that 30, which means that I can be right, wrong, right, wrong, right, wrong. But if I'm right and wrong all the time, but I'm still using the same position size, it'll equal itself out. If I'm right, and then wrong, but when I'm wrong, my position size is twice as much as it was when I was right, well, it means that I'll wipe out all my gains and I'll start again, right? So what we're doing is we're trying to get the probability in our favor, and we're trying to ensure that we don't overexpose ourselves on our bad trades. Now, here's another thing. Right. When it comes down to your risk reward, very important thing. A lot of traders, they think, well, I'm going to go with a high probability trade, which means I'm going to put my stop far further away from my entry point than my take profit. It means that I'll be taking profit more often. This may be the case, and it does work quite a bit, but all it takes is for you to be wrong once, and you will lose more than you did all those other times you gained. So what we're trying to do is maximize our reward and minimize the drawdown on that account, right? So that's what we're aiming to do. So that being said, this is the first of many daily updates that I'll be putting together. Again, I will be putting something together where we can have a look at our fundamentals. One of the key things that I do in terms of fundamentals is that you don't need to understand everything about monetary policy, fiscal policy, quantitative easing, what is PPI, CPI, GDP, or whatever it is, right? All you need to do is know which economic releases are going to have a fundamental impact on the US equities market. And the reason why the US equities market has an impact is because, again, like I mentioned, there's many portfolio managers that have Bitcoin on their books. They don't care what the underlying asset is, right? What they will do is they'll look at things with the highest beta, right? And what that means is the things that move the most. If there is a interest rate, if Powell decides to increase interest rates and the markets pull back, by how much do they pull back? The S&P will go down 1%, Bitcoin might go down 4%, Ethereum could go down 20%, right? And the difference in the percentage that drops, that's known as your beta, right? So that is the degree to which the underlying security drops. And that is how risk is monitored through something called a beta coefficient. And so when we have a look at something like the S&P 500, which is obviously an index of US equity stocks, we can see that we can plot the beta around that point. And what portfolio managers will do, they will drop the highest beta. They will drop the ones that are holding the most risk. And Bitcoin is at the top of that list, right? So that is why when there's bad economic news, if they're getting a little bit fearful, they will dump crypto as soon as they possibly can, which is why it pulls back so much. And this is where your correlation happens between macroeconomics and the traditional markets and Bitcoin now, because the institutional investors are holding it on their books, right? So this is why what we want to do is we go on to a source of news. I use Financial Juice. I think it's fantastic. They're very good news market data provider. It's specifically for retail. I know that when I was obviously working in banking, we had Bloomberg, but these are very expensive for retail traders. So Financial Juice is great. And the way we do it is we just have a look to find out which are your main market moving events that's going to happen for the day, so we can expect to find some volatility. What normally happens is because the crypto markets are driven primarily by technical analysis, what happens is the technicals we put in place, like we have this bear flag going up, and if there's a high volatility event, it will either be a muted response or not so muted response. If the technicals are aligned in the direction of the economic release, there'll be a very big impact. Either that, or if there's a very big miss on what the expected figures were, right? However, you normally find it's a bit of a muted response when the technicals and the fundamentals contradict each other. You're going to have a lot of people trading off technicals, a lot of people trading off fundamentals. But when they align, that's when they really move. So what I try to do is look to when it's going to break above a certain resistance or support level. And then is there a big market moving event or a big economic release that will have a material impact on the on the price of Bitcoin, and then that volatility should blast it through those levels. So that is kind of how I trade on that side. But again, make sure you keep an eye on your risk management. Don't over leverage. Again, we are starting with $10 now. We are going to try and get that as high as we can. We're aiming for about 10,000 US dollars. And if I can turn $10 into 10,000, it means I can turn 10,000 into 10 million. So let's just see how we get on. But welcome to Weapons Trading, and it's been a good day. Happy Friday and good luck, traders. All the best. Bye.